Okay, so in this video, we're going to go over how to find the net present value, the internal rate of return, and the modified internal rate of return for a series of cash flows. So here's our problem. Given the specified cash flows shown above for project A and project B, find the net present value, internal rate of return, and modified internal rate of return for both projects. Which project should be chosen if it is only possible to choose one? Assume that the risk-adjusted cost of capital is 13%. Then, repeat your analysis using a risk-adjusted cost of capital of 19%. Which project should be chosen? So we have two projects here, Project A and Project B, both of which are going to last for 6 years and have the specified cash flows. So to start, what we're going to do is we are going to set up a column to find the specified net present value, internal rate of return, and modified internal rate of return at the 13% risk-adjusted cost of capital. So let's put in 13% here. So we're going to have a 13% cost of capital. Okay. All right, and let's make that just a little bit wider. All right, so we have a 13% cost of capital. So now what we're going to do is we're going to calculate the net present value for project A and the net present value for project B. So our formula for net present value, as you might expect, is equals NPV, open parentheses. The first thing it wants is a rate. So we're going to select our cost of capital rate, comma. Now it wants value 1. And when it says value 1, it really does mean value 1. It does not want year 0 incorporated at this point. So we're going to highlight from year 1, click, hold, and drag to highlight all the way through year 6. We're then going to close parentheses. And now we will add year 0 outside the NPV function. So we have our NPV, this is our rate. We've highlighted the cash flows per year here, and then this is our year 0. And we get $193.94. So let's try the same thing for project B. So equals NPV, open parentheses, rate, and now we're going to highlight values 1 through the end, and we're going to close parentheses, and then add in year 0. So, lo and behold, $195.70. So far, project B is looking a little bit better, and it has a somewhat higher net present value, not by much, but a little bit. So now we're going to calculate our internal rate of return. So the IRR for A and the IRR for B. Now in the case of the IRR formula is IRR. And in this case, we actually highlight all the values. So year 0 all the way through the end. That'll give us the internal rate of return for project A. And then we'll do the same thing for project B. Highlight from year 0 all the way through the end. Close parentheses. There we go. And to keep things consistent, let's move that out of decimal place. There we go. So in this case, project B has the slightly higher net present value. Project A has the slightly higher IRR. Well, now let's calculate the MIRR. So the MIRR for A and the MIRR for B. So as at this point you might guess, the formula is MIRR, open parentheses. It asks for values, so we'll come up here, we'll highlight all the values. Then we have a comma, and it asks for a finance rate. So this is your cost of capital, your risk-adjusted cost of capital. So we are going to select our cost of capital figure there. Now, the MIRR function in Excel also has a spot for the reinvestment rate. So the rate we are assuming we are reinvesting at when we get the different cash flows. Now, generally speaking, if we had a cost of capital of 13%, and let's suppose we had a project that was getting us an IRR of 27%, just numbers chosen at random, of course, then you would expect that if we had projects that were getting such high rates of return, I should hopefully be doing them, which would mean that the projects that I haven't really started pursuing yet, on average, in any given year in the future, would probably be the projects that are getting me a rate of return much closer to this cost of capital. So as a general principle, what we will assume is that our rate of reinvestment is going to be our applicable cost of capital rate as well, although in some cases you may have a different experience or a different situation that requires you to use a different reinvestment rate. But for our purposes, we will assume that we are reinvesting right at the cost of capital because we have already pursued all of the other attractive projects. So now I will close the parentheses. And if we have done this correctly, the MIRR should land somewhere between the cost of capital and the IRR. So let's see how we did. Lo and behold, it's in between there. So we have a 17.9% MIRR. Let's repeat the process for project B. Okay, selecting the values, and then comma, our finance rate will be the cost of capital, and then our reinvestment rate will also be the cost of capital, and then we'll close parentheses and enter. All right, so let's kind of review what we have here. So based on the net present values, net present value is telling us that project B looks better. The internal rate of return is telling us that project A looks better, and the MIRR is telling us that project B looks better. So in this case, really what's sort of pointing us in different directions is the IRR and the net present value, because net present value is telling us pick project B, and the IRR is telling us pick project A. So we have a conflict. And as a general principle, when we have a conflict, we are going to side with net present value. The reason for that is that net present value assumes that when you get these cash flows every year, you take those cash flows and you reinvest them at the specified cost of capital. The internal rate of return implicitly assumes that when you get a cash flow at some point in the project's life, that you reinvest the cash flow in another project just like this one. And as that could be quite a bit of a restrictive assumption, it is generally better to assume we are reinvesting in a more normal project, hence the risk-adjusted cost of capital, and therefore the assumptions underlying the net present value are typically considered to be better than the assumptions underlying the internal rate of return. So if I'm faced with a conflict, I'll side with net present value. So what that's telling us is, if I can only choose one project, in this first scenario, we'll choose project B. And the reason for that, it has a higher net present value, it does have a higher MIRR, has a lower internal rate of return, but because the net present value is based on a more robust methodology or more sound assumption, we'll assume that the project B is the better choice. So our choice then will be to choose B. All right, so now what we're going to do is repeat the analysis using a risk-adjusted cost of capital of 19%. So in this case, we'll just set up another column here, and we will repeat the calculations. So equals NPV, and the rate this time is going to be 19%. And then our value 1 for project A, starting in year 1, continuing through year 6, close parentheses, plus, incorporate year 0, and enter. And it's a lot lower, and it's a lot lower because we have a higher discount rate, so the present value of these future cash flows has gotten a lot smaller. So now if I repeat this process for the second project, again, I will incorporate the rate, and then value 1 through the end, close parentheses, and then year 0. And lo and behold, it is also lower than it was at 13%. And interestingly, notice that at this point, project A has the higher net present value. Now, if we look at the IRRs, and we calculate that again, we get the same number. We get exactly the same number that we got before. And the reason for that is very simple, because the IRR is finding the discount rate at which the net present value is equal to 0. So because the IRR is not dependent upon assuming a discount rate, but it is a discount rate, it is the risk-adjusted cost of capital at which the net present value is exactly equal to 0, or the cost of capital at which the net present value is exactly equal to 0, then the IRR is the same regardless of whether the specified cost of capital is 13% or 19%. So really, we don't actually even need to calculate the IRR twice because we're going to get the same exact number both times as long as we're doing it properly. So I'll go ahead and remove that. Now for the MIRR, that's not the case because recall for the MIRR, I did have to specify what that cost of capital was. So because I have a different cost of capital, I'm going to get a different set of numbers. So let's calculate this again. So equals MIRR, and now we're going to highlight our values. And comma, it asks for a finance rate, which is now 19%, and a reinvestment rate, which is now 19%. And we'll close parentheses. And it turns out the MIRR is actually a little shy of 22% for project A. And if I repeat the process for project B, incorporating the finance rate, and incorporating the reinvestment rate. And to calculate that. And it turns out, in this case, that the MIRR is actually a little bit higher for project B. So in this case, what we have is actually kind of an interesting scenario because based upon the net present value, project A has a higher net present value. And based upon the IRR, project A has the higher IRR. Based upon the MIRR, project B has a slightly higher modified internal rate of return. So just a little bit higher there. So net present value is telling us to pick project A. IRR is telling us to pick project A. The MIRR is telling us pick project B, but they're pretty close in this case. So when faced with that conflict, probably what we'll do is we'll go ahead and side with net present value again because we are increasing shareholder wealth by the most. And importantly, what's causing some of the conflicts that we have between these different methods of evaluating the capital budgeting choices is the fact that we have different project sizes, so different initial investments. And obviously, the scale or timing of the cash flows is a little bit different. And that's causing some of these conflicts. So in this case, what we'll do is we'll probably side with net present value here. And so we'll say that we should choose project A because it has the higher net present value. And that is how you can find the net present value, the IRR, and MIRR of projects if you have specified cash flows. So at this point, I recommend that you try a few examples and see if you can calculate the correct answers. And hopefully you were following along with this video. And if not, I recommend you go back to the beginning and actually put these cash flows into your spreadsheet and calculate the net present values, the IRRs, and the MIRRs in order to see if you can obtain the same results. And that will give you a little bit more confidence when working some of these problems.